Okay, welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I am very excited to be back to discuss with us part 2 of a video that we had started in October, which was the #1 options income strategy. Today, we're here to talk about the most underutilized options income strategy. And for those of you that were here back in October, you know that I took a few weeks off because me and my wife welcomed our first child. So baby Max is here. He is doing great. Everyone is healthy and happy. And I actually have him in my arms right now while I do this webinar. So I hope everyone is doing well and looking forward to be back here today. But let's go ahead and get started. But before I do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So when I talk about the most underutilized option strategy, I'm referring to what we call as short puts. And short puts is a strategy that, in my opinion, should be used far more often by investors, but it has a bit of a negative connotation because a lot of investors see this as a strategy with a huge amount of risk, and they see it as a strategy that takes a lot of capital. And both of those things potentially are true. So we want to talk a little bit about when you should use it. Obviously not suitable for every single investment opportunity, but there are plenty of them where they are. And I want to talk about what those opportunities are and how do you find them. And I think the best way to always learn is to take a look at a real example. I'm going to show you some trades that I found earlier today and how to go about finding optimal short puts using our income reports available to everyone here at OptionsPlay. We'll talk a little bit about the trade management of these short puts and some live examples before we open this up for Q&A. Thank you so much, everyone that said congratulations and welcome back. I appreciate it. I'm looking forward to be back here as well. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can you invest for the future with a discount using a short put strategy. And it's really for really investing for the future, meaning stocks and ETFs that you want to put into your portfolio for a long-term investment. These are the types of opportunities that allow you to use a short put to purchase them at a discount. So that's what we're going to discuss here today. And like I said, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I'm looking forward to talking to you again in my 16 years of trading options, why I think this is the most underutilized strategy that everyone should be utilizing, meaning anyone who's trading stocks or ETFs should be utilizing, but many of you do not. So before we jump into this, how many of you currently trade or buy stocks or ETFs for the long run in your portfolio? Please type 1 into the chat window if you do buy stocks or ETFs for your portfolio. And please type 2 if you do not purchase any stocks or ETFs at all. I just want to get a quick sense for the audience here in the room. So pretty much I have seen all ones. I actually haven't seen a single 2. Usually there's a couple of you that don't trade any stocks or don't buy any stocks, but pretty much I see that every single one of you have answered 1. Okay, perfect. So this basically what we're going to discuss here today is pretty much applicable to everyone. So what is a short put? And many of you may already be familiar with this strategy, so I'll quickly just review this for anyone who's new to short puts. But effectively selling a put option on the stocks that you wish to purchase will allow you to earn yield on the cash that you need in order to purchase those underlying shares. And today I'm going to use Macy's as an example. You can really replicate this for just about any symbol that you are interested in buying. I was looking at Macy's simply because it's a retail stock that recently has performed very well, had a bit of a significant pullback here over the last few weeks or so. And maybe you think that this is an entry opportunity to look for some further upside here for Macy's. Now, this is not, again, any form of a recommendation or suggestion that Macy's is a good investment. I'm simply using this as an example as a very strong stock, a stock that's outperforming the overall market that has had some pullback and has the opportunity to look for some further upside. So perhaps this is a stock that you've been eyeing for a while. You didn't like the stock at 36 bucks, but now that it's pulled back, roughly a third, you think that now is a good trading opportunity. And when you sell a put option, you're going to have an obligation to potentially buy the stock at a specific price. And we're going to talk a little bit about this and why that's so important, because this is going to help you understand why short puts is something you should utilize instead of another strategy that you may currently use when you're buying your stocks. There is one major limitation here for selling puts, and it's that it requires you to have the cash to purchase 100 shares of that stock or ETF. So when we're looking at Macy's, it's a $26 stock, $2,600. Many of you may have that in your portfolios. But if we're looking at stocks like Tesla or Amazon, where you need 100,000, 100,000, 300,000, those types of numbers, you may not be able to do this on stocks like Tesla and Amazon. But certainly we'll show you how you can find opportunities for lower price stocks using this strategy. Does that make sense, everyone? Please type 2 into the chat window if this makes sense to you. And like I said, we haven't dived into the strategy yet, so we'll talk a little bit about that next. Okay, so first of all, that's what a short put is. So let's talk about an example here, and I'm using Macy's again as my example. So whenever we sell a put option, what we are going to do is we're going to collect premium. As the seller of the option, the buyer of that put option is effectively paying us that premium, and we get to use that premium to effectively give us a potential discount on the stock price at the strike price. And selling a put option, a lot of investors I hear over the years tell me, well, I don't like to sell puts because there's a lot of risk, right? If the stock was to drop to zero, I'm taking on $2,600 worth of risk per contract. I don't want to do that. Well, the one thing I will tell you is that when you buy a stock, you're taking on the same risk, right? When you buy a stock, the risk is that the stock plummets to zero. But yet, if you're comfortable enough to take on that risk to buy the stock, then you should be comfortable enough to sell a put option, because selling a put option, as you're going to see in the next slide, is actually less risk than buying the stock itself. So once you sell the put option, you have two possible outcomes. You can either own the stock at a discount, meaning a price that you're comfortable with owning the stock at with a discount factor, or you simply keep the income from the short put. Those are your two possible scenarios. You either own the stock at a discount at a price that you like, or you get to keep the income. Both scenarios are pretty good outcomes for when you sell a put option. And that's why I think it's the most underutilized strategy for retail investors who are purchasing a stock. And what you're going to find is that the second piece, the income that you receive from the short put, will typically average significantly better than the dividend yield of that underlying stock, and better than the average market returns as well. So even if you never own the stock that you want to own, just the income itself will greatly outpace the dividend yield and outpace the average market returns. So this is really where I think, again, not only do you get the benefit of potentially owning the stock at a discount, but you also can gain quite a bit of a yield on the cash that you set aside for this strategy. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about your long-term investments, right? And we're going to use Macy's as an example. This is just a educational example, but let's say I want to buy 100 shares of Macy's at this $26 support level. As I said, this is a stock that was trading at 36 bucks 2 weeks ago. It's pulled back significantly to that $26 support level. Maybe you think that now is a good opportunity to potentially get in. You think it's going to revisit that $36 level, right? So it pulled back to 26, and you think it's going to rally back to that $36 level. So as an equity investor, what do you do? And this is the part that everyone here on this call is probably familiar with, which is placing a limit order to buy the stock at the price that you want to purchase the stock at, which is $26. You place a limit order and you buy the stock if it hits that level. But as a put option, whoops, this is a typo. This should say put. But as an options investor, what you can do is you can sell, let's say, a $26 put option, the exact same price that you would place a limit order for, sell a $26 put, but the premium that you collect on this particular trade is $1.50. So by selling the January $26 put option, I collect $1.50. And remember, when you sell a put option, you have the obligation to buy the stock at that specific strike price. Now, what does that sound like? It sounds exactly like a limit order. A limit order obligates you to buy the stock at a specific price if the stock hits that price sometime in the future. So when you compare a limit order and a short put, you have the exact same obligation. But the difference between a limit order and a short put is that a short put pays you $1.50. $1.50 may not sound like a whole lot, but as you're going to see on a $26 stock, that's a 5.5% yield. So you're getting effectively a 5%, a little over 5% discount on your stock purchase. So when you buy the stock with a limit order, you're taking on the risk of about $26 a share, exactly $26 a share. Because if you buy the stock at 26 and the stock goes to zero, you're risking $26 per share. But if you sell a put option, what you're risking is less than that. You're risking the same obligation of buying the stock at 26, but because you collected $1.50 in income, your total risk is reduced from $26 a share to 24.5. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Because the first part, what we want to do is make sure that you understand that by selling a put versus placing a limit order, you're first and foremost, reducing your overall risk. That's key, right? Whenever you have the option of buying a stock, you're always risking that the stock declines. This is one way to provide some form of a cushion against that risk. And in this particular case, $1.50 cushions you against the first 5.5% decline in the underlying stock. And then when you look at your potential rewards, meaning if the stock rallies from the $26 support level that you're expecting to the $36 target price that you have, if you look at your potential rewards, if you, as an equity investor, you're looking at about $10 per share in potential rewards in exchange for your $26 worth of risk. In your short put investor, you're taking on $11.50 of potential reward for $24.50 of risk. So you're skewing the risk to reward in your favor as a short put investor. Now, there is a major difference here between the two. It's not fair to compare these apples to apples because in a limit order, there's a couple of things. One, with a limit order, you can do it for any number of shares. You can place a limit order for 1 share, 1,000 shares. There's no limitations on that. And you have no exposure to the stock until the stock declines below your strike price. But as soon as the stock declines below the strike price, you now have exposure to Macy's. On the short put side, first of all, there's a limitation of the fact that you have to trade in 100 share increments. So you can have the obligation to buy 100 shares, 200 shares, 300 shares, but nothing less than 100 shares. So you have to trade in 100 share increments. That is one major limitation for a short put. The second limitation is that despite the fact that you are generating $1.50 effectively a month in income, you don't have exposure in Macy's until the stock is below the strike price at expiration. With the limit order, you have exposure as soon as the stock declines below 26. So if that happens tomorrow after you place the limit order, you now own the stock and you have exposure. With the short put, if the stock declines below $26 tomorrow, but by the time you get to expiration, the stock is above 26, generally speaking, that put option will not be exercised, meaning you will not own the stock. But what you will keep is the $1.50 in income. And we're going to show you the difference between the two in 1 second. Does that make sense, that those limitations? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about the potential outcomes here. So when you sell a put option here for $26, you sell a $26 put option for $1.50. One of the things that you're going to notice is that as an equity investor, to buy 100 shares of the stock, you need $2,600. That's how much cash you need to buy 100 shares. When you sell a put option, because you're collecting the $1.50 or $150 per 100 shares, what it requires is only $24.50 in terms of cash. So you're effectively getting that $150 discount. That's where we have the 5.5% calculation from. So if the stock is above $26 at expiration, and apologize, this should say 26, not 126 at expiration. If the stock stays above $26 at expiration, the puts that you sell effectively become worthless. That means you keep the full $150 or the 5.5%. And what you're going to potentially miss out on is some upside. Meaning if, let's say, the stock starts to rally up to $36 and you never get put to this particular this put option, you're missing out on that upside. But what you do keep is $1.50 or 5.5% yield on your cash. But what you do have is the option to potentially sell another put option. So meaning at some point in the future, if you still think the stock is going to rally, you can sell another put option. So once the 30 days is up, you're collecting 5.5%. And remember, this is 5.5% in a single month. This is not 5.5% over the full year. Many times, when we're thinking about dividend yields, 5.5% dividend yield is certainly on the high end. It's not the highest you can get. There are plenty of energy stocks, some telecom stocks that pay 7, 8%. It's not the highest you can get, but this is not 5.5% per year. This is 5.5% per month or per 30 days. So that's just to show you how high the yield is on a strategy like this. So this just hopefully helps put into context how much yield you're actually potentially missing out on by using a short put option versus buying the stock. Does that make sense? Please type 6 into the chat window if that makes sense to you. So the limitation here is that you may miss out on upside, but the 5.5% over 1 month does annualize to quite a bit of yield over the full year on the stocks that never get, where you missed out on some upside because you didn't use a limit order versus a short put. Now, if on the other hand, the stock does decline below $26 at expiration, this is your strike price. Well, now the puts are assigned to you. So effectively what you do is you own the stock at 24.5, which is the $26 plus the dollar or minus the $1.50 that you're collecting. So you're owning the stock at $24.5, which is a 5.5% discount on your stock purchase. So basically your two outcomes, you either keep 5.5% as yield or you get 5.5% discount on the stock that you wish to purchase. And it really just depends on whether the stock is above or below the strike price at expiration. Does that make sense? Please type 7 into the chat window if that makes sense to you. Perfect. So next, I want to do a little bit of an exercise here. And I want to kind of get everyone's thought process on this front. So, this is the chart of Macy's. I've shown this to you before. It's a clear uptrend. It went a little parabolic. I believe this was on earnings, and the stock has pulled back significantly. And let's not even get into expiration dates, because you certainly have a lot of choices when you select expiration dates, right? You can choose, 1 week options, 30-day options, 90-day options. I'm going to save you the research and the time to figure this out, and just tell you outright, based on our research of backtesting, short puts across just about every single expiration cycle, the optimal expiration is about 30 days to expiration. So let's just talk about strike prices. Let's talk about, with the 30-day option, what are the strike prices you can choose? And we're going to use this example where Macy's is currently trading at about $26.78, so a little above, close to 27 bucks. And I have 3 choices here. I have the $26 put option, I have the $25 put option, and I have the $24 put option. So 3 potential short puts that you can sell. This is the 26, this is the 25, and this is the 24, just to show you some price levels on the underlying chart. A $26 put option will collect $1.50 or about a 5.5% yield. Annualized, that comes out to 69%. The 25 collects $1, which is about 3.9%, annualizes out to 49%, or the 24 collects 75 cents, which annualizes to 34%. And these are the break-even prices on those put options. If you sold the 26, you would own the stock at 24.5. If you sold the 25s, you own the stock at 24. If you sold the 24s, you own the stock at 23.5. If these put options are put to you, those are your effective costs to own the stock. Now, I want to ask everyone here, if you had the choice of selling put options on Macy's, which one of these 3 would you choose? The 26, the 25, or the 24? You can type your answer into the chat window here. I see a lot of 24s and 25s. I see a couple of 26s, but predominantly I would say the numbers, most of you have said 24 or 25. A few of you said 25 delta. Okay, that's in, I also have the deltas here, and we'll talk a little bit about deltas and kind of how they affect your decision, okay? Okay, It looks like the overwhelming answer here is the 24 and 25. Some of you have said 26. I see 140 delta. Someone would said 40 delta. Someone said 30 delta. Okay, so I'm going to tell you what I would choose here, and I'll walk you through why. A few people saying 23, so even lower. Some people really choosing strike prices all the way down here. So I'm going to show you, based on our research, the overwhelming evidence shows that the optimal short put are the 40 delta puts, the puts that are really close to the current price of the underlying stock. Now, for those of you that joined me, this has to be about a month and a half ago, where we did the session on the #1 options income strategy, which are covered calls. We talked about that when you're selling covered calls, you want to sell calls that have a low delta, a price that's really far away from the current price of the underlying stock. And this was so that you have capital appreciation on your stock. But when we look at short puts, we find that the opposite is true. You actually want to select strike prices that are very close to the current price of the underlying stock, or a high delta. So in this particular case, this is a 40 delta. A 40 delta means that there's a 40% chance that Macy's will be below $26 at expiration. The 30 delta means there's a 30% chance the stock will be below 25 at expiration. The 24 delta is the $24 strike price is a 25 delta, meaning there's only a 25% chance that the stock will be below $24 at expiration. Effectively, the lower the strike price you choose, the lower the probability you will own the stock. So why do we choose this high delta strategy on this short put option? There's really two primary reasons. One, you want to collect as much yield as possible. So here I'm collecting a 5.5% discount on my stock purchase. So what you think about it, you're trying to buy the stock. You're trying to purchase the stock with the largest discount factor. The puts at the closest to the current price of the stock will give you that largest discount factor. But the second reason is because you want to actually own the stock, because this is a stock that you think is going to go from $26 to $36. That's where you're going to mostly make your money. You're not going to make most of your money from selling put options. You're only collecting $1.50, but your upside here is $10. You want to capture those $10, and you want to be able to have a good probability of actually capturing that. So you need to choose strike prices that are close to the current price, that have a very high probability of owning the stock. And when I say very high probability, 40% is still less than 50%. So you have a less than 50% chance of owning the stock. And if you have about a 60% chance that you're just going to earn this annualized yield on your cash. So that's really why when we're talking about short puts, you want to choose strike prices close to the current price of the stock. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. And I know a lot of investors tend to choose these lower price puts because you're thinking to yourself, I want a put option that has a low probability of success. But that's actually the exact opposite of what you want, because now you're potentially missing out on upside. And if you do get put the stock, you have a lower discount factor. Here, I have a 5.5% cushion against the stock decline. Here, I'm only getting a 2.75% decline or protection against my stock purchase. So let's talk a little bit about how to find these opportunities. So I'm using Macy's here as just a quick example, right? And I want to show you how I found Macy's. So what we publish here at OptionsPlay is what we call a short put income report. And this is a report that everyone who is a member, or if you're on a free trial, you will have access to this report. And this report will show you all of the S&P 500 and very liquid ETFs, and it's updated every single hour for you for the best short-term opportunities to sell put options. And it's sorted for you based on the highest annualized and raw returns. And this is designed to help you find opportunities on stocks with the largest discount for a stock purchase. So I'm going to show you this report here and how to access this and walk you through this particular report. So let's pull this up here. This is a report that you can find in the OptionsPlay Hub. You can find this at the optionsplay.com/hub or within your OptionsPlay platform. If you click on the education and resources link on the upper right-hand corner, it's going to take you to the OptionsPlay hub. And when you scroll down to the short put report, this is where you can find the best opportunities to capture the most yield and get the highest discount factor on your stock purchase. So when you click on the short put report, the report is sorted already for you based on the raw return of the underlying stock. So this is the discount factor that we're referring to. So what I typically like to do is simply go down the list or simply search for stocks that I want to purchase. So you can either go down the list and look for stocks that you want to purchase. So I was looking down the stock and Macy's came up for me. And this was what I found here was the January 7th, 26.5 put options that were collecting $1.73. And you can have all of the metrics that you want to look for in this particular trade. And you can simply just click on the symbol on the left-hand side to populate this trade within OptionsPlay. So I always tell, if you're looking using this page, simply just take a scroll down the list when you're ready to buy some stocks, when you're ready to purchase some stocks. And first of all, see, are there any stocks that are, yielding 5%, 4%? These are pretty high yields that you like to purchase. Maybe you really like JetBlue as an airline. Maybe you really like American Airlines. Maybe you're ready to take some risk with some of the casino stocks like Las Vegas Sands. Well, this is all available to you simply by clicking on the symbol here and being able to see the trade within OptionsPlay. So this is looking at the January 7th, 26.5 put options. This is now collecting $1.73. Now, just to put that into perspective, that's a raw return of 6.46% in just 29 days. 6.46% in 29 days. Compare that with 0.55% in a full year. So if you own Macy's as a stock, you're collecting 0.5% per year. Versus selling the put option, you're collecting 6.5% in just 29 days. That's how big of a difference these actually are compared to the dividend yield and compared to kind of what you can expect in terms of returns from the market. And this is something that or if you just have a specific stock in mind, let's say which stock you want to purchase. Let's say you want to purchase a Citigroup as a stock. Well, you can just type it in and you should be able to see it here, Citigroup, where you can look at the January 7th, $61 put option that's collecting $1.37. It has an IV rank of 22%. It does report earnings on the 14th of January. And this earnings flag here will tell you whether there's earnings before, now, or expiration. So the stock is at 62.5. You're selling the $61 put option. This is going to give you a 2.2% discount on the particular trade, or a 27% yield. And this is a strike price that's about 2.5% below the current price of the stock. So you have all of these metrics here within the spreadsheet, or you can simply just click on the link and you can view this trade within OptionsPlay. And just to reiterate, you can find this link in your education and resources link at the top of your OptionsPlay platform, or you can go to the optionsplay.com/hub to access this report. All of the reports are available to you from the hub. There's a cover call report that we covered a couple of months ago before I left for paternity leave. That was the last income webinar that we did. And today we're following up with part 2, which is a short put report. Both of these reports work the same way. One is for cover calls, one is for short puts. But that's how I found the Macy's example. As you can see, using this report, I don't have to do a lot of work in terms of scanning for opportunities. I can simply just go down this list on stocks that I want to purchase. Maybe you think Peloton's way oversold. This was a $100 stock 2 months ago. It is now a $41 stock. Maybe you think a 60% decline is the bottom here for Peloton. So maybe you want to take a stab at picking a bottom here. Now, picking a bottom is never easy to do, but the stock's down 11% today, and you think that perhaps, hey, I can get a 7.8% discount on the stock purchase. Hell of a interesting return here, a 98% annualized yield on this over the next 29 days. So obviously this is a higher risk trade, not for everyone, but for those of you that are looking to take on a little bit more risk, these are the types of returns that you can expect from the higher risk trades. And then if you want to look for something lower risk, so let's scroll down further down the list. Let's look at something that's in the 2% range. Maybe something like Bank of America, far less risk, but you're still going to get a 2.44% discount on what is considered, I would say, a fairly stable blue chip stock. You can still get a sizable discount. Let's take a look at Bank of America here. And I want to use Bank of America because this is a dividend paying stock, right? With these types of financials, with these banks, you have a dividend paying stock. Bank of America pays 1.77% for the full year. Here, you're getting 2.54% in the next 29 days. So you're getting a slightly more than the dividend yield in just 1 month than what you get in the full year from Bank of America. You're getting paid 78 cents per share per year using this from Bank of America. But here you're getting paid $1.13 in just 29 days. So hopefully this illustrates just how big of a gap you can collect in terms of income from a short put on a stock that you want to purchase versus just the dividend yield alone. A lot of you may be dividend investors. A lot of you pay attention to dividends, but may not have considered how much more yield you can actually collect from selling a put option versus just the income that you're collecting from the dividend. So let's talk a little bit about some of the tips that I have for finding yield. Number one, a lot of investors ask me, how do you choose stocks on this list? And it's a great question. And the answer is you should only focus on stocks that you are familiar with and stocks that you're comfortable investing in. So it's hard for me to tell you what you feel comfortable investing in. Everyone here is different. Some of you like to take on more risk and you like to take on, growth stocks like Peloton, and others are very conservative. You want to look at blue chip stocks like Bank of America that are very stable. Well, the risk, the yield will be commensurate with the amount of risk that you're willing to take, but stay in your lane. Stay with stocks that you like. Don't search for high yield if you're not comfortable with risky stocks. First of all, focus on what you're comfortable in owning, what you're comfortable investing in, and only look at the yield that you can collect in those stocks. Don't worry about what Peloton's going to yield if you are a conservative dividend investor. So make sure that you understand the risk that you're taking. The second thing is when you're looking at kind of these deep discount stocks, I always think you should sort by the raw, you can sort by the raw return and always compare it with the dividend yield. That's always going to give you a sense for how much yield can you collect on the short put versus how much yield are you actually collecting from the dividend itself. And I do think for many of you that are looking at this, it's important to look at earnings because we have the earnings flag on our report. And if you want to avoid selling puts going into earnings, make sure that the earnings flag is you see how there's a no or a yes. So if it's a no, then there's no earnings coming up. But if you have anything that's a yes, and let's find you one, like Lululemon. Lululemon reports today after the close. That's why it's a yes. But some other stock, like for example, CFG, this reports on January 19th, but you're selling a January 21st option. There's earnings between now and expiration. So be careful and understand whether there's earnings between now and the expiration date, and make sure that you choose ones that predominantly don't have earnings coming up. For some of you, you may be comfortable taking on that risk, but many of you may not be comfortable with that. So be aware of the earnings flag and just making sure that you're selecting options that do not have earnings coming up. And lastly, when you have a small account, this is probably one of the biggest things that I hear from short put investors. They'll tell me, I don't have the cash to put up for 100 shares of the stock. Well, the great thing about our report is that you can sort it based on the stock price. So you can look for just low price stocks like JetBlue or Kinder Morgan. American Airlines. You can look for just low price stocks and only look at selling puts on stocks that are costing, require $1,500 in cash, $2,000 in cash, $2,500 in cash, and simply avoid all the stocks that require tens of thousands or potentially hundreds of thousands of dollars that are required. So for example, if you want to do Adobe, well, you need $63,000 in order to sell one contract of Adobe. So just sort it based on the stock price, and that's going to allow you to find opportunities based on your portfolio size. So this is a report that's really built for anyone for a wide range of risk tolerance, a wide range of account sizes, and also a wide range of different types of stocks. We're covering the full S&P 500 list, every stock that's in the very liquid stock or ETF space. So when you're looking at the OptionsPlay tool, anything that's in the S&P 500, anything that's very liquid in terms of stocks or ETFs, they are all included in this report. There's about 700 or something symbols here that are covered by our short put report. So most stocks that you would be investing in are in this report available to you. So with that, that covers what I wanted to share with you today. I hope that this was helpful in giving you a better understanding of short put options and just how they can be utilized in your portfolio. For those of you that are brand new to OptionsPlay, you can sign up for a free trial, a 30-day free trial to everything that I showed you here today at OptionsPlay.com. You'll get access to the short put reports, you'll get access to the OptionsPlay platform, and you'll get access to daily trading signals that we send for entry and exit signals for options based from our research team. So you're going to get a free 30-day trial to everything, including the report and the platform, by signing up for a free trial at OptionsPlay.com. And you're going to be able to join me every single Thursday going forward with these education sessions to help you learn different strategies. I love doing this. I'm really glad to be back and doing this again. And I really appreciate all of you that have made it out here today. I hope that this was helpful in giving you a better understanding about short puts and what I consider, again, the most underutilized option strategy for income for retail investors. And thank you everyone for your wishes. Baby Max is doing really well. Thank you so much. I'm really happy to be back, and I can't wait to share with everyone. So with that, what I'll do is I'll open this up for Q&A. If anyone has any questions, you can type your questions in the Q&A section. I'll try to answer as many questions as I have time for before I have to run here in about 8 minutes or so. So there's a Q&A section and a chat window. Please type your questions in the Q&A section, and I'll try to answer your questions in that section. What do you think about rolling down and out a cash secured put for a stock that went down during the life of the option? There's nothing wrong with doing that. You're obviously, you're now paying a debit to potentially roll that down. So I'm not a huge fan of doing that. But if you simply are not comfortable buying the stock at the original price point that you sold your original put at, then it is a strategy that you may consider. How much money in an account would be set aside to cover for the short put? So you need the cash amount, which is effectively the strike price minus the price of the option. So if you sold something with the $10 strike price and you are collecting 45 cents, then you need $9.55 or $955 per contract. So it's the strike price minus the mid price, or the price that your trade is executed at, multiplied by 100 for every contract that you have, because each contract is for 100 shares. That will tell you how much cash you need to set aside in order to enter that individual strategy. Is 30-day optimal for short put? Is the same applicable for a put spread? We tend to find that put spreads, you want to go a little further out, because put spreads, you have to also purchase that put option. So 30-day options, you're not quite collecting as much income. So put spreads, we usually go out about 45 days. How come Macy's has a technical score of 10? Because it has greatly, even though despite the pullback here we've seen here in the past week or so, it is still outperforming more than 90% of the underlying stocks in the market. So even though despite the massive decline, it's still outperforming most of the other stocks in the market. Remember, a lot of other stocks have also pulled back here as well. So it's all about outperformance. It's not about whether it's bullish or bearish. What if you don't want to own the stock? So Chris, you should not be selling puts on stocks that you don't want to own. So this is only for stocks that you want to own. And selling a lower price put on a stock that you don't want to own is not a great strategy, because with a 30 delta, you have a 30% chance of owning that stock. Now you have a 30% a chance of owning a stock that you don't want, and you're taking on that risk. So do not sell puts on stocks you do not want to own. What about a strike that's slightly in the money? Well, I wouldn't suggest anyone to sell an in the money put option, because an in the money put option means that you're collecting less premium. So in the money put option, so if I look at, if I look at Citigroup here, instead of selling the $60 put option where I'm collecting 78 cents, it's, what you're looking at here is the extrinsic value. The further the stock is in the money, the less the extrinsic value you're actually collecting. So this is really where you want to make sure that you understand how much extrinsic value you're collecting. And actually, as you go further in the money, what you see is your annualized return actually gets lower and lower, because the extrinsic value of the option is decreased. So that's why you don't want to sell an in the money option. Will you get assigned if the strike price goes above your strike price? No. So if the stock ends up above your strike price, then you will not get assigned, only if it's below your strike price. How do you calculate raw versus annualized? Well, raw return is pretty simple. You're just taking the cost, how much you're collecting in income, and you're dividing it by the strike price. The annualized return is basically taking into account how many days it's taking you to earn this $330 and basically annualizing that number. So if you earn $330 every 22 days for the full year, how much yield are you collecting? That's how the annualized returns are collecting. How do you know if to sell a put or a call? Well, Claudia, you have to choose. First of all, if you want to buy the stock, you want to sell a put option. If you own the stock, then you want to sell a put option. Do you favor high or low volatility for short puts? Well, high volatility is definitely going to favor selling puts. And that's why we have this implied volatility rank number. So you can actually sort this based on implied volatility rank. Ones with the highest implied volatility rank are the ones that have the highest relative yield for that underlying stock. So if you look at Morgan Stanley, 2.88% is a relatively high discount factor for this particular stock. As you can see, the current implied volatility is in its 89th percentile. So extremely high yield for this stock. Normally, a stock like Morgan Stanley, you're not going to be able to collect, close to, 3% on Morgan Stanley. These are the, kind of more boring, slightly more conservative in terms of risk, in terms of stocks. So those are the ones that you do tend to favor when you do that, because normally in normal times you might only be able to collect $2.50 or $2.25. Here you're collecting almost $3 on Morgan Stanley, so you're getting a bigger discount factor on Morgan Stanley. Does the report indicate delta? So what we're finding is the optimal delta, which is about 40 deltas on these types of reports. Is there an exit strategy if the stock drops in value? So, not really, right? Because you are selling a put option on a stock that you want to purchase. So, do you have an exit strategy on your limit order? Basically, if you sell the put option and some new information comes out and you basically no longer want to own the stock, well, then perhaps, meaning based on new information and you're making a new decision that, a week ago you wanted to buy the stock, now you don't want to buy the stock again. As soon as you realize you don't want to buy the stock, you just want to get out of the short put, buy back the put. Otherwise, you're really, stick with it. As long as you still want to buy the stock and you're comfortable with the price at which you want to buy the stock, stick with it and let it go to expiration. Would the short put selection criteria be the same with the wheel strategy? Yes. So I'm going to talk about the wheel strategy next month, which is really combining a short put and a cover call into one single strategy. But yes, with the wheel strategy, it's basically combining what you're learning today with what you're learning a month and a half ago with our cover call webinar, and putting the two into the same on the same underlying stock. What's your recommendation if you guess wrong and Macy's drops to 20? Well, what would you do if you bought Macy's stock at 26 and it dropped to 20? It's up to you as to whether or not you want to own that stock, right? And whether or not you want to hold that stock through any volatility, if you will, because that's the decision that you make with every stock investment, right? You buy a stock, you hope that it goes up, but if it goes down, you have to choose, is this a stock that I want to remain invested in? So that's a decision based on your own risk tolerance, not based on the put strategy. But I will say a drop down to 20 bucks is going to hurt less if you sold the put option than if you bought the stock at $26 using a limit order. How do you calculate the maximum risk for a short put? The maximum risk is your cost basis, which is the strike price minus the price that you were executed at. So if I sold Nike for $165 and I collected $5, my cost basis on that is about $160. That's my max risk. If the stock goes to zero, I'm losing $160 per share once I've sold the put, versus if I bought the stock, I'm risking $165. Thank you so much to everyone that said congratulations. I really appreciate it. If you don't want to be assigned the stock but want to make a little income, what delta might you want to target? I will admit, I don't think you should sell put options if you don't want to own the stock, because you have a higher degree of chance of owning the stock. You can choose a lower delta, but I don't particularly think that's a great way to generate income. You're better off maybe selling a put credit spread rather than selling a low delta put option. And again, all the questions regarding how do you deal with the stock dropping? Well, how do you deal with the stock dropping after you purchase the stock? It's a question based on how much pain are you willing to take? How much volatility are you willing to experience in that underlying stock? With a stock like Macy's, you should expect a fair amount of volatility. So if it drops 20, that might be somewhat within the realms of what you can expect from Macy's. So the question is really just, how do you, how much pain are you willing to take, or how much risk are you willing to take on a stock purchase? Again, what you really want to think about is, I'm taking on significantly less risk selling the put option and owning the stock that way than if I just use a limit order. The short put doesn't prevent you from losses. What it does is it limits those losses to a smaller degree, but ultimately it's a stock that you want to purchase. And with any stock that you purchase, you have to take on risk to the downside. And it's completely up to you as to how much of that downside you're willing to take before you sell that stock, or if you simply hold on that stock for the long run. Wayne, as far as, put option that you sold and the stock is now up 10%, Wayne sold Peloton put options last week. The stock's up 10%. Do you still hold the trade to expiration? That's up to you. If, let's say, you're comfortable with the gains that you've made on the short puts, and you say, you know what, I don't want to own this stock anymore. The stock's up right 10%. I don't think it's going to come back down. I've made 80% of the premium that I sold the puts on, and you're comfortable taking the gains on that. There's no harm in doing that. But ask yourself, are you gonna, if the stock does get to your strike price and you miss out on some significant gains to the upside, if the stock gets back to $150, are you gonna, be missing out on that upside? That's really the question you should be asking yourself. Can you sell a naked put option on margin account? Yes, you can. It's going to hold less capital. Usually it's about 20% of the capital of the stock price. You can look up, how margins are calculated on a short put. Each brokerage firm has their, slightly different margin requirements on that. So I suggest that you talk to your broker, but yes, you can sell this on margin, and it's going to require less cash, which actually means that you have a higher return if the puts expire worthless, but it also means that you have more risk if you are leveraging your account to sell put options. How difficult is this strategy in an IRA? So I would say IRAs are more limited for capital, right? Because you can't just deposit, extra money into your IRA account. You can only deposit a certain amount every single year. So you're more limited in terms of size with an IRA rather than the strategy itself. Is POW equal delta? Yes. So the POW on a income tab here is equivalent to the delta. Claudia says, I want to see the replay of this and the selling of cover calls, please. Yes, Claudia, both will be available on our YouTube channel, which you can go to optionsplay.com slash, youtube.com slash optionsplay. As a member, how do I access that report? Again, the reports are available to you in the education and resources link here at the upper right-hand corner of your screen, or you can simply go to optionsplay.com/hub. And I'll post the link here into the chat window here for those of you that want to access these reports. Where can I find the part 1 cover call webinar? You can find it on YouTube, which again, I'll post the link here at www.youtube.com/optionsplay. So both links are now in the chat window for everyone if you want to watch the recordings or if you want to access these reports. Do you focus on high IV or high IVR to find potential short put opportunities? Always look at implied volatility rank, because implied volatility, doesn't really tell you much. You want to know how it's doing relative to itself. Morgan Stanley, some stocks just have very high implied volatility, but maybe it's relatively low for that stock. So you want to use IVR, not IV, for finding these opportunities. Yes, this is the first half of the wheel strategy. So the wheel strategy is the short put and the cover call combined. But instead of showing you the wheel strategy as in one webinar, I wanted to focus on each half of the wheel strategy. So next month, I will talk a little bit about the wheel strategy and just combining these two strategies into one. What should we look for when making the comparison of the return to the dividend yield? What you just want to make sure is that the return that you're collecting is higher than the dividend yield. If you're selling a put option where the yield is less than the dividend yield, then not really worth it, because the risk that you're taking is not worth the potential income that you're collecting. What happens when you sell a $26 strike and the stock goes down to 16? Well, I asked you the same question. What happens if you buy the stock at 26 and it goes down to 16? What do you do? The short put doesn't change how you want to react to stocks that you purchased and the stock declines, right? What it does do is it cushions your trade by about $1.50. So if you bought the 6 at 26 and it's down to 16, normally you would lose $10 a share. Here, you're only losing $8.50 a share because you've cushioned yourself from that first $1.50 of losses. That's how much you're collecting. But selling a put option doesn't protect you from the stock declining. That's still a decision you have to make. And that's why I said only sell puts on stocks that you are comfortable with and stocks that you're familiar with, because then you're going to be able to make that decision as to, okay, I bought the stock at 26. I understand the value of this stock. Now, if the stock declines to $16, what's my view on this? Is it now a cheap stock that I really would like to own and continue to own and maybe buy some more? Or is this now a stock that perhaps has changed? I thought it was worth 26. Now that it's worth 16, I'm reconsidering. I should probably cut my losses and get out. That's only a decision you can make, and that's a question that you have to answer. A short put doesn't change any of that. The only thing that a short put changes is how much you actually risk if the stock were to decline. Can you sell a put less than 30 days and continue to sell puts to collect premium? Juliet, great question. Yes, you can, but we generally don't recommend it. Juliet's question is, instead of collecting in Macy's, instead of selecting, the January $26 puts and collecting $1.39, can she sell 1 week options? And let's say you do a $26, you collect 63 cents. You can do it, Juliet. However, remember, every single week that you do this, you have a relatively, you have about a 40% chance you're going to own the stock. So if you end up owning the stock after the first week, you're now owning the stock at only a 2.35% discount. That's the risk that you run, that you're not getting a sizable discount on your stock purchase. It could work out for you if you are able to have 3-4 weeks of short puts that expire worthless. You're going to collect more premium, but with a 40% chance of expiring worthless, or I'm sorry, a 40% chance of owning the stock, you may not get to that 3 to 4 week window where you've collected more premium than selling that 1 month option. So for those reasons, we generally don't recommend selling less than 30 days on a short put. Ernie, I've learned about your spread philosophy. Wide spreads make me nervous. So Ernie, then choose spreads that have a lower stock price. You still want to choose those wide spreads relative to the stock price. So if you think that the spreads are too wide, look at a smaller stock price. Those spreads will be wider, will be narrower. How can you set your settings to match the report? To match the report, you basically have to use income settings, short-term, aggressive for short puts, short-term aggressive for short puts. Robert, because it's not actually $1.50, I rounded the $1.50 just for rounding purposes to show you. I think the actual number was $1.45 or something like that, and that's why it was 5.5%, not 6.12. I was using the $1.50 as just kind of round numbers. Okay, that covers the questions that I have time for here today. I really appreciate everyone taking the time out here this afternoon. We will make sure we get both the recordings and the slides out to you on YouTube later today so that you can watch these at your own time. Again, like I said, this is by far the most underutilized option strategy in your portfolio. In almost every single one of you have answered that you buy stocks or ETFs in your portfolio. So if you do that, consider using the strategy the next time you want to purchase 100 shares of that stock, because it's going to cushion you against that first percentage, a few percentages of losses if the stock does decline. It may allow you to hold on to that stock a little longer if you experience some volatility in the short run. And if it doesn't, and if it puts expire worthless, you're going to collect a fair amount of yield. And hopefully today illustrates just how much yield you're able to collect. With that, I will see you guys next Tuesday on a very special session that I'm hosting with Tom Sosnoff, talking about futures trading. So we're going to be embarking 2022 with monthly education on futures trading. A lot of you may not know, but I have a background in futures trading. That's how I started my derivatives career. So I'm really excited to be coming full circle, talking to Tom about futures trading and kind of what are the different products that are available to you to gain access to some of the futures contracts, specifically small sized futures contracts for retail traders. So I hope that you'll be able to join me on Tuesday. That's a special session we're doing at 4:15 p.m. With Tom Sosnoff. Hopefully some of you can join us here for that. With that, thank you so much. Have a great trading day, and I'll see you guys here on Tuesday. And I'll also be back here next Thursday for our regular Thursday afternoon session. Thank you so much and have a great evening.